Welcome to this week's series of Credent Connect, and today we're going to focus on our path to year-end and then discuss some of our asset allocation, risk management, kind of our thoughts for 2025, which, a little disclosure, we are going to release our views of 2025 here this month. We're excited for that document to come out. General thoughts on kind of what we're optimistic about, neutral, and maybe some potential risk and uncertainty down the pipe. But as we're looking here at December 2024, and as we're heading into year-end, we're post-election, we're in this area of the market, time of the market, where some might call the Santa Claus rally. And the reality is the Santa Claus rally has not truly transpired on a broad breadth. What that means is it has not really impacted all stocks equally. We've seen the U.S. large cap growth market, right? Those artificial intelligence heavy type stocks do extremely well, almost double the rate this month than most of the other side of the market, more of the value stocks, some of the smaller stocks away from the large cap space. What's interesting about that is seasonality, which means how do stocks react at different times of the year from year to year. Seasonality is a critical technical factor that we kind of look at, not as a must do because things will transpire that way, but as a gauge of where the trend and momentum may be heading. When we look at 2025 from that perspective, and given that it is the first year in a 4-year presidential cycle, historical data leads us to believe that it is the weakest of the 4 years of the presidential cycle in terms of returns. That doesn't mean they're negative returns, doesn't mean they are zero returns. It means that there may be more volatility and there may be more subdued structure to those return profiles, which we have accounted for. And we'll touch on that. But before we do that, let's talk a little bit about the macro snapshot from a macroeconomic standpoint, because as we're heading into 2025, there's the Fed, there's the labor market, there's the housing market. There's certainly uncertainty of some valuation structures. Give us kind of our view, Alicia, a little bit heading into 2025 from a macro standpoint first before we talk about allocation structures.
When we think about the macro, one of the most important things is the labor market. So coming into 2024, there was a lot of uncertainty on how strong the labor market would continue to be. And what we found was that the labor market has been pretty resilient over time. So the unemployment rate is still historically low. It has ticked up to 4.2%, but we're not seeing initial layoffs that are, dramatically higher. We are seeing continuing claims creep up a bit, but overall, the gist is most people who are looking for a job are still able to find a job.
Yeah.
And that has really helped with consumption.
Yeah, very good point. I think that consumption piece continued to showcase resilience in their latest earnings data and continues to do so in the GDP reports. One point about the labor market that I think bears significance here is that white-collar jobs over the past 6 months have increased at twice the rate of most blue-collar jobs. So when we look at that data and try to extrapolate it from an economic activity to manufacturing, to those types of things, as it relates to investment allocations, it builds quite an interesting picture in that the jobs that tend to have the highest attribution to economic growth are doing fairly well heading into 2025. Alicia, from a monetary policy standpoint, right? The Federal Reserve interest rates, we've heard President-elect have mentioned that he's going to keep Powell where he's at as the Fed chair. A, should we care about that? B, what's the likely path of interest rates, either for fixed income portfolios or for those even attempting to buy a home in this environment?
We should care about that because the Federal Reserve is independent from President Trump and anyone who is in office, and that's a very important distinction.
Yeah.
As far as monetary policy goes, the market is pricing in about 75 basis points of rate cuts next year. So I think when we think about monetary policy, there is risk in the fixed income market because if inflation does stay high, that's going to be a detriment to interest rates and a detriment to home buying.
Yeah.
If we see more rate cuts down the road, that's probably because we're seeing some economic weakness in indicators. That will be a net positive for the same things, for bonds as well as home prices.
Yeah, good point. I want to reiterate the fact that we still fundamentally believe the biggest risk to investment allocations in 2025 is tied to bonds and not stocks. And although that may sound counterintuitive, we think of it from a function of what is the best hedge for inflation and what is the best outcome to recover from any volatility in a faster pace. For us, that's the equity market. It is not the fixed income market, despite the short-term benefit that is derived from downside mitigation. And lastly, here from that downside mitigation piece, close us off here, Alicia, with the equity market participation hedging structures that we have into place into 2025, roughly around that GDP announcement timeframe in the second quarter. Walk us through that a little bit as to why we're doing it and what it is.
Yeah, so when we think about equities, like you said, we are more bullish on equities. I mean, earnings are there, the disinflation trend is there. We're seeing some broadening, but we want to have that risk management in play. So what we have in play is using structured assets to mitigate some of that downside protection. We have those maturing around May when we have that GDP announcement. If we see some volatility, that will help us protect against some of that downside market participation, which then allows us to go back into the market at better valuation. So that is a really key risk management point that we have in play across our portfolios.
Mathematically, if you lose less on the downside, you need less room on the upside to be better off than before. That's our goal. We'll stick through it very objectively in 2025 and beyond.